Hello, I'm Russ Mould, AJ Bell's Investment Director. Sorry, I can't see you at Investival in person this year, but nevertheless we're going to plough on with a little short presentation just to try and give you a bit of a context for what's coming up in the year ahead and frankly the years after that, because there are potentially some very big changes afoot that could have huge implications for advisors and clients' asset allocations on a strategic basis. So this is quickly what we're going to be talking about today: irresistible forces and immovable objects, and then just one or two pointers to help you follow which of those may be prevailing, again with potential implications for strategic asset allocation, depending on where, of course, you're pointed already. So let's talk about immovable forces, irresistible objects. What are the forces? Well, the biggest one right now is the global pandemic. Is this a second or a third wave? Is it going to be brought under control? Can it be brought under control? There is perhaps a mirage of control. Controlling a virus, we've not been so good at dealing with the common cold or flu for the past few hundred years. So even if there is a vaccine, could that be a chimera? Could that be a false hope? But now, and even if we do get a vaccine, or indeed it's just put back in its box by herd immunity, and I'll leave you to decide which case you think is right, will there be long-term effects upon behaviour that have impacts upon the economy, corporate cash flows, profits, and therefore portfolios, even if next to other people's health, they're probably, let's face it, a secondary priority. So that is at the moment perhaps the biggest force, the biggest challenge for markets. We've seen a recession in response. How quickly will we get out of that, and what will the long-term impacts be? What are the irresistible objects that pandemic is banging up against? Well, really, it's fiscal and monetary support, fiscal and monetary stimulus. I saw a report from Bank of America Merrill Lynch in the summer that said that over $20 trillion of fiscal and monetary response had been put forward by governments and central banks, which, if you put it in the context of the World Bank's forecast of a 9 to 10% drop in global GDP this year, well, that's roughly $9 trillion of lost output. So you've got a 20 trillion plus response combating a 9 trillion hole. It does. You can say on the face of it that governments and central banks have acted quickly to provide support where they feel it's been important. Now, whether that's going to be enough to get us to escape velocity, let's face it, the economy wasn't exactly firing on all cylinders beforehand, remains open to question. But you clearly have central banks now talking about inflation averaging and allowing inflation to run hot, assuming, of course, they can get it to target in the first place. You've got governments, the UK now being an example, going back to the well, keeping support schemes going when it hoped it'd be able to bring them to a halt and continuing to run record deficits. And you've now got the Democrats presumably coming in, legal suits permitting in the US, and there is a faction within that party that is very, very much in favour of modern monetary theory, the belief that it just doesn't matter how much money governments spend or print because interest rates are low and there'll be no rebellion from the bond market. Now, that maybe is one fringe of the Democratic Party. They may be reined in by the fact the Senate has remained under Republican control, but nevertheless, there is a school of thought out there that says we can just keep on knocking this stuff out and it really won't matter. So you've got recession, pandemic on one side, huge amounts of fiscal and monetary support on the other, and which one's going to prevail could have substantial implications again for financial markets, looking at things just through that narrow prism as a secondary to the wider issue of public health. So as we can see from this graphic, inflation expectations have begun to nudge up gradually over the past 2 or 3 years, and they've taken another step up this year, again perhaps with the possibility of a Democratic president backed by a Democratic House and maybe even a Democratic Senate at one stage. That blue sweep doesn't look like it's happened, but nevertheless you've still got a Democrat coming in with a mission to spend, a plan to tax as well to some degree, and that has led to some increase in inflation expectations, as indeed of President Trump's trade policies, fracturing of global supply chains, insourcing of production to more expensive domestic onshore facilities, another reason why inflation expectations have crept higher. Now, as the Financial Times newspapers pointed out in the past 2 or 3 days, this chart has actually just gently rolled over, and the FT even proclaimed that the inflation trade was dead as a result. Now, I'm not going to be cocky enough to second guess the FT, but it's not just price inflation that is one measure of inflation. We'll come back to that in a second, but this is an easy chart to follow, and it's certainly going to be one that again could help drive sentiment going forwards. Now, this is again looking at price inflation. We can see an increase in US factory prices. Some of this will be down to trade policies, fracturing of supply chains, And believe me, getting hold of things like container shipping and air freight right now is extremely difficult. Talking to my wife who works in retail, you can't even find a cardboard box in India. So there are some pressures in the short term on the supply chain, but these US factory price issues may reflect longer term ones as well. So that's one way of looking at inflation. But another one is money supply. And this is the Austrian School of Economics' thought process that in the end, increased money supply and particularly increased velocity of money will lead to inflation further down the road if the volume of goods and services don't keep up at the same time. So you've got the chart on the left here, which is the UK, and you've actually got a pretty big increase in money supply here, and that chart goes back to the early 80s, and the US an even more dramatic increase up into the 20s rather than the UK is in the teens. Now, Austrians will be all over this like a rash, saying, okay, there might not be inflation now, but the premise is there. You've got money supply, and you've got supply-side destruction through companies going bust, companies cutting capex, reining in supply, and the fracturing of global supply chains. And that's why they will argue that inflation is coming. Now, on the other side, you've still got some powerful objects and forces that we've discussed. You've got potentially demand-side destruction, unemployment being a key case in point. And again, companies frightened for their lives, trying to pay down debt, trying to cut capital investment, cut costs as fast as they possibly can to see them through these highly uncertain times. So you've got supply-side destruction on one side, demand-side destruction on the other. What the Austrians will say is, but look at all this money. If, heaven help us, it starts moving around quickly, and it isn't now, but if it does, that's when you really could begin to get inflation. Now, at the moment, a lot of this money supply, or the central bank portion of it, is coming through quantitative easing, through bond buying programs, creating reserves with the banks, hoping that the banks then lend that money out. Now, that hope has been largely frustrated for several years, and this may be the blockage in the mechanism. So what happens, some will argue, if central banks cut out the middle person and go straight to the people's QE and start putting money directly into infrastructure projects, or through central bank-backed digital currencies, start giving money directly to the wider populace. And that's what the Federal Reserve has been releasing papers on recently, possibly actually opening a digital currency account for individuals with private people who can then withdraw and spend. And if that's the case, the Austrians, I suspect, will start getting very, very concerned about not just supply of money, but velocity of money. We're not there yet. Inflation is still subdued, and a price mechanism, as the FT is pointing out, even if expectations have risen. Money supply is there, velocity is not, but these are both trends that we need to be aware of. Why? Because this is when you could getting a change in debates such as soft assets versus hard assets, and within soft assets like equities, growth versus value, for example. Now, we're all very familiar with the chart. Growth and momentum strategies have wiped the floor with value strategies. Many a well-known value fund managers lost their job, or at least underperformed horribly as a result. And this chart on the left makes that perfectly clear. Even if intriguingly, of course, what growth has done is really just recapture the underperformance that it suffered during the first 10 years of this millennium, when value was all the rage after the collapse of the TMT bubble. But growth has been the only game in town. Value has worked to a degree. You've had about an 8% compound annual return for the last decade. It's just that has been left in the dust by growth and momentum, tech and biotech being the shining examples. So what would make this change has been one of the key questions. There have been numerous failed value rallies. There were actually one before Investival 2019, intriguingly enough. It didn't last very long, and there have been others. One possible trigger point would be a surprisingly strong economic recovery, either because the vaccine just goes back into its box as there is some herd immunity, or current policies work, or a vaccine is found, or whatever it happens to be, we suddenly get and stimulus kicks in, we get a rip-roaring recovery. If that's the case, why would you want to be paying huge multiples for growth stocks when you can find cyclical growth in the street with downbeaten value stocks at fractions of the same multiples? And that's going to be a big debate for your fund managers to address. Now, some have got clear growth styles, some have got clear value styles, but some will be agnostic and just looking to find the best performance they can from their chosen asset class. And that could be a big trigger point. And you can see from the graphic on the right here how when bond yields have gone up in the US, you have seen value, as tracked by a US exchange-traded fund or tracker, put on a bit of a spurt, and that does seem to be an interesting trend that's worth watching. But as soon as bond yields have rolled over and there's been fears of, oh no, back to a low growth, low inflation, low interest rate world for as far as we can see, that is understandably when secular growth stocks like the FANG stocks or tech or biotech have really come into their own. So again, the Austrian money supply or price inflation could be a trigger for a move, the long-awaited, long-expected move from growth to value. It hasn't happened yet because you haven't seen a sustained recovery in cyclical earnings or indeed in inflation. So in conclusions, well, I guess there are multiple scenarios, and if I knew which one was coming, believe me, I would tell you, but there are multiple possibilities. The first one is we get a weak recovery and we get more of the same, low inflation, low growth, low interest rates or even negative interest rates, and that probably leaves us where we are now, falling over ourselves to look at bonds, falling ourselves to get stuck into growth, because that's where you're probably going to come out best if history is any guide. Now, I know there's no guarantee there, but it's the only guide that we have. If we get a strong recovery, again, whether it's vaccine or stimulus or just immunity, that is when inflation expectations could start to rise, or at least we begin to get a cyclical uptick. That could mean perhaps a move from long duration assets to shorter duration assets, like cyclicals, and even perhaps things like emerging markets and Japanese equities, which are much more geared into a cyclical recovery through their heavy exposure to the key cyclical industries there, whether it's manufacturing or airlines or steel or pulp or semiconductors, whatever it happens to be. Third option, probably the trickiest one, maybe slightly where we're teetering now, a second or a third wave, more lockdowns, prolonged policy response, and even a violent policy response in terms of fiscal stimulus and more monetary stimulus. Bank of England's just uncorked £150 billion worth of more QE. Australia's turned to QE for the first time, cut interest rates. Bank of England openly talking about negative interest rates, and if you do get more policy stimulus blocked on Capitol Hill because of this ongoing bipartisan Democrat House, Republican Senate problem, the Fed may be the one that's asked to step up with more QE or even cutting rates. It doesn't seem keen on cutting rates into negative territory, and I can't say I can blame it, but more QE is a distinct possibility, and that's why Bitcoin may be at $15,000. It may be why gold is back to nearly $2,000, because that would play to real assets. The Austrian school would say, look, how can you possibly print more money and have it keep its value? If anything else is created ad infinitum or to huge supply, it surely loses value, and the Austrians would say the same about money. Now, I know, again, head of investments Kevin Doran here at AJ Bell, he's in the gold's a barbarous relic camp. He would try and kick it if it wouldn't hurt his toes, and it's not going to appeal to an awful lot of investors or advisors or clients. But right now, there's no denying it's running strongly. Bitcoin's running strongly, and it may be because there is an expectation that there is going to be so much money printed in response to a second or a third wave, or just a very weak economic recovery or double-dip recession, that may be things to consider. And agriculture is running strongly right now because of La Nina, and if you draw the chart going far enough back, it's pretty clear that equities have absolutely hammered commodities, soft assets have hammered real assets for a very long period of time. That hasn't always been the case, and the last time we got real inflation in the 70s, hard assets were the one place that really helped preserve wealth and indeed create wealth going forwards. So that's a very short sort of 10-15 minute overview, but check out those key charts on not just price inflation, but on money supply, and if velocity starts to pick up or you start to see the people's QE, that's when maybe we do see a big shift in portfolio performance, the biggest we've seen for the last 10 or 15 years. Keep well, stay safe, and hopefully we can all meet in person at Investival 2021.